This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. What if you could combine the best of hedge fund strategies, including active management, with a value approach to stock picking? And what if I told you that a particular approach has clobbered the market for nearly a decade, all while holding absolutely zero technology stocks? My guest today is a portfolio manager who has done just that. Nathan Miller runs a model fund for Emles advisors that has recently launched an ETF that sort of mimics what he does in his team's investment strategies in just 3 or 4 sectors, including consumer, retail, and industrials. The Emles Alpha Opportunities ETF, and the symbol is EOPS, you could say, holds a unique basket of value-oriented stocks, some of whose names might surprise you, like Restoration Hardware, pushing new all-time highs today after another big beat and raise quarter, Signet Jewelers, Camping World Holdings, and Lockheed Martin. Then this is one of the first actively managed long-short ETFs. So it's got that hedge fund feel to it, but you really can't compare it to anything else out there. Mr. Miller calls himself a contrarian value investor who follows a quantitative methodology devised over decades managing money for the likes of Citadel and RBC Capital. He spent a lot of time as an analyst for industrial and defense stocks as well. And so not surprisingly, he knows how to play defense through economic cycles. He considers himself a quantamental investor. You may have heard that thrown around. It's a combination of having quantitative methods and screens and fundamental stock selection in their approach. What struck me about his approach to stock picking is that as this value guy, it doesn't have him behind the market and complaining that it's just not time for value yet. He's done amazingly well on several metrics, and right now, with sky-high valuations in cloud stocks, he sees an inflection point in the current cycle that investors can take advantage of without running to cash or trying to time the next hot industry. We're going to learn how Nathan picks value stocks and what he expects over the next 1 to 2 years for his holdings. We'll also talk about his short positions. Nathan, welcome to Mind Over Money.
Thank you for having me on your podcast, Kevin.
Oh, you bet. So let's start with your view on technology stocks, because I bet you a lot of people are curious, and how you just decided you're not going there and what you've been able to achieve for the last decade.
So generally speaking, the technology sector is sort of outside of my sphere of confidence by design. And the story that most people don't realize is I graduated during the height of the dot-com bubble. I actually invested in a lot of mutual funds and worked at Lake Mason in college for several years. And I always tried to buy diversified funds, value funds, science and technology funds. And in the first 2 years of investing in the T. Rowe Price Science and Technology Fund, I learned that diversification within a sector is sort of an oxymoron. You can't do it. And when the dot-com crisis ended, I graduated in 1999 and got a job offer at Goldman Sachs. Specifically chose a role to do old economies and cyclicals. I didn't really understand how to value technology companies. They seemed expensive, but I've always been a contrarian by heart, and I don't need to keep up with the herd. But broadly speaking, technology is highly competitive. It suffers from rapid technological change. There's not necessarily sustainable pricing. There's always an endless source of capital chasing, and so there's always new entrants coming after you. And, my view is 20 years after that, today, the technology sector is really the tale of 2 totally different sectors or business models. You've got mature, legacy, proven technology companies that will weather any downturn, and they're cash cows. And then secondly, you've
got
Microsoft
and Apple, right?
That's exactly right. And companies that are cash cows, high margin, immune to downturns. I mean, they are utility-like. And there have been times I've been trading at low multiples, and they've been great purchases. But I'm not an expert in the space. What I'm more concerned about is the dramatically higher valuation, sort of unproven emerging companies. Those are what concern me the most because they haven't proved they're durable. They don't prove they have barriers to entry throughout the course of the cycle. and nor are they profitable enough of entities to really not hurt them during a downturn. So there's a difference in my mind between great companies and great investments. I am, very valuation sensitive. People that invest in disruptive, innovative stocks and are agnostic to valuation are almost doomed for failure. And all of the statistics, all the academic research points to that. So just statistically speaking, if you're buying the lowest decile or lowest quartile stocks over time, over the long run, you're bound to outperform. And so the high level, kind of caution sign in my mind is that today about 30% of the entire market cap is in that one sector of technology. And we saw a similar scenario with financial stocks in 2007. We saw a similar scenario where almost 30% of the market was in tech stocks in the dot-com bubble. And to me, that's just the flashing kind of warning sign to be careful. So truthfully, I've always been a value investor. It's a humbling business. You can't always be right, but I worry about probabilities and kind of making money on average over the long run. I have thick skin. I ignore the herd, ignore the skeptics. I mean, even Warren Buffett looked like a fool in the late 1990s. And with time, 3, 4, 5 years later, he proved to be, the smartest one in the room.
Yeah. All right. So I want to drill down into some of your holdings and then we'll zoom back out and talk about more of your process. Let's go ahead and talk about Restoration Hardware after, I'm sure you're not surprised by another beat and raise quarter, but you've actually been buying Restoration Hardware for like the past 5 years when it was trading $25 and you still hold it as one of your biggest positions. How is Restoration a value stock?
So I would argue it's probably not a value stock today. It's probably more of a GARP stock, right? Growth at a reasonable price. Mm-hmm. As a value investor, what we care about is our entry points and then making sure there's no permanent loss of capital. So the last time we purchased the stock was last March, April, and May when the stock was in the 80s. We also purchased call options. We haven't added anything to that since the stock was under $100 a share. And frankly, every sale I've made over the past few years has been a mistake. And that's the humbling part of the business is you're always wrong. But being a value investor is about buying stocks while they're dramatically undervalued. So I started doing a deep dive in the late part of 2016, early part of 2017. Restoration Hardware sort of screwed up the rollout of RH Modern, a new furniture line they were launching. And the stock went from over $100 a share to $25 a share. And that's what kind of piques my interest. Those are the types of moves that I look for. When a company was trading at, 30 times earnings, and now you get the opportunity to buy it at 6 or 7 or 8 times normalized earnings. And so at the time, consensus had fallen to under $2 a share in earnings, but we could pencil out, I'm an analyst by training, our theory was they were going to do over $6 in earnings. And there were a couple of elements that were important there. The first one was they were getting pricing power. So they were in control of their own destiny. And, this is kind of the Peter Lynch school, buy what you know. I was a customer of RH for several years. I bought pieces of furniture for our house. And I noticed they were dramatically increasing their pricing. Every time I would call them to order more chairs or more furniture, they were, 8, 9, 10% higher than the prior year. And, that's the luxury good business that they're building. They're really a Giffen good, which is strange to think about. But pricing power is a recurring theme in the analysis that we do, and that's what gives them a competitive advantage. So the other parts of the pattern recognition, Gary Friedman was an owner-operator, right? At the time, he owned over 20% of the company. There was a 75% short interest in the company, right? The 4 largest shareholders owned over 100% of the float. There was a large incentive package that Gary Friedman's board had given him if he could get the stock price from the 30s or 40s up to $150. And the kind of nail in the coffin for me was they bought back over half of their shares, right? Half of their float over 2 quarters. And kind of consensus on Wall Street was, well, you never have great margins as a retailer of furniture. And, Gary's crazy. He might be bankrupting the company by buying back stock. Now, I've been through lots of different cycles. And generally, when companies are doing large accelerated share repurchases, they know something the rest of the street doesn't. And in this case, they already knew that they were, successfully raising pricing and driving 800 to 1,000 basis point operating margin improvement. So that was the background for RH. We really started buying it in the mid-20s and then got dramatically larger as a position. And it's been a core position for the past 4 years. But our cost basis is about $46 a share.
Well, congratulations on that one. I'm looking at the stock price right now, and you're cruising on being if the pace keeps up today above $725, it'd be the 3rd highest close ever just shy of the all-time highs near 740. So just a spectacular play there, and I can see why you still hold on to it given your cost basis.
And patience is important as an investor because it takes a long time to get compounders. But when you find the right management team doing the right thing, they're just now starting to expand internationally, right? Opening stores in Paris and England. And so there's still a lot of growth behind them. But Gary likes to tell the story of since Restoration Hardware went public, the performance of their stock has outperformed every other company in the market. Apple, Google, Facebook, every single what you think of as a successful stock, and RH trumps them all. And it's a little fact that most people don't realize.
Well, yeah, I mean, that just a spectacular rebound from the Corona crash lows. I can't believe you were getting to buy shares at 80. You must have been, just thrilled about that. And who would have thought? Like, I was thinking, okay, Restoration Hardware, don't they depend on people coming to the showroom to see and buy stuff? And apparently that wasn't the case. They adapted their model where people were buying and shopping from home, basically, right?
Yeah, and that's a recurring theme. Most legacy brick and mortar retailers have now adopted omni-channel online commerce, the ability to sell over the phone or online. Restoration Hardware specifically has kind of in-store designers that you work with. So virtually none of their revenue comes from cash and carry. You don't buy furniture and carry it out of the store. For the most part, you order it, either through a designer or through their website. And so it's kind of a unique business model. But that's true. We'll get into some of our other holdings. It's true with Children's Place. It's true with Signet. It's true with a lot of our names. They are all becoming online retailers. They're being forced to, but the pandemic and COVID really accelerated that.
Yeah, we'll get to those. I want to finish up with Restoration. So you mentioned the designer aspect, right? Yeah, the people who are buying, the $8,000 couch. I'm exaggerating, but you get the idea. They're working with a designer, so that adds a level of service at the high end. Going into England looks huge. Could be as huge as California, obviously. And I think you were telling me, so once they've got their margins down, you're saying that's a key to long-term success. Can you explain that?
Sure. So high level, the mark of a good business or a high barrier to entry is a high margin. So the higher your gross margin and the higher your EBIT margin, the more defensive your company is in the long run. You can weather a downturn. So in Restoration Hardware's early days, when they were doing kind of low to mid single digit EBIT margins, anytime you had a recession and you lost 15 or 20% of your revenue, it was catastrophic. It took you from a marginally profitable business to a basically hemorrhaging cash. And so what good companies can do is elevate their brand, drive pricing, and get a better, kind of more predictable, higher average margin through the course of the cycle. And then you don't really have to worry about discounting. You don't have to worry about promotions. And it becomes kind of a cash cow throughout the cycle. And so today, if you just take a model and you assume a 10% or a 20% decline in revenue, there's no decremental margins. It's not that margins will be going down in a recession as they historically did. So it just provides more insulation to the stock price, and it should be less volatile, going forward. And that's true when most companies mature.
Okay. I expect to hear you say some similar things about our next stock, which is Signet Jewelers. And another one that surprises me because, I'm like, is this a luxury spending via, stock market wealth effect? Or is it some snapback from all the weddings that got postponed last year? Or is there some surge in pandemic romances that I'm not aware of?
A little bit of all, but this is basically a roll-up of a lot of different brands from Kay Jewelers to Jared, et cetera, et cetera. And again, this goes back to our entry point, right? The stock was $150 a share in 2015 and 16 and 17. We had the fortune of following it closely because I started my career as a industrials and cyclicals and then spent time as a retail analyst at Goldman Sachs. Before moving on, I spent 10 years with the same investment team between Goldman Sachs and SAC. So this has been in my coverage universe for a long time. But essentially, the stock got down, and our average price here is between $8 and $10 a share from last March, April, and May. And if you just look back at the normalized earnings, which is an analysis we do, what does a company earn over the long run? It's almost a Case-Shiller type PE ratio to understand what your valuation is or what your earnings yield is over the course of the cycle. This is a company that's routinely, earned $6 to $7 in earnings. and the stock was trading under 8 times. So you're buying it at 1.5 times normalized earnings. A lot of things can go wrong when you're buying companies under 2 times earnings. And so our theory when we were buying it is, the stock is probably worth $60 to $80 at 10 times normalized earnings. And here we are today, essentially they were doing less than $2 a share in earnings a year ago. And today they just reported this week, they're now guiding to over $9 in earnings, and they've beat and raised 5 quarters in a row. And so our view is they successfully pivoted to online retailing.
So basically under 9 times right now.
So that's correct. It's a stock in the 70s. We still think it's cheap, right? It's trading well under 9 times earnings, which is a recurring theme for everything in our group. We bought it well, and because the earnings have grown so dramatically for Signet and Children's Place and Kohl's and Camping World and Lazy Days and Dine, because the earnings have grown so fast, the stocks are still cheap even on today's earnings. With Signet specifically, though, they've done a great job on cost cutting, right? They took $300 million out of their cost structure over the last 2 years, and that flows right to the bottom line. But they've also successfully been able to offer kind of online purchases. And so, last year was a great example of where the majority of their business, even when the stores were closed, was done online, and that's not going away. So, for instance, holiday season is very important to them. They've already got more than 50% of the merchandise in stock today, so we don't worry about any supply chain disruptions. And our view is their new normalized earnings on a go-forward basis are probably $10 a share, not $6 a share. Trading at, you're right, 7 or 8 times normalized earnings.
All right. So with RH and Signet, I'm on board with these guys as premier brands, top of the line dominators, and still have brick and mortar facilities. But then your other plays, you've got Kohl's, you've got Children's Place, and Camping World Holdings, 3 that can't we order all this stuff online? And are these places doing so well with online, or do people still flock to the stores?
It's kind of ironic because you're seeing more people go back to the stores than I would have expected. I personally can't stand, walking to a store and buying things. So we order almost everything online, and we have 4 small children. But again, the recurring theme is there are dominant brands, right? If you need to buy children's clothes, Children's Place is the #1 retailer in the country. So they've closed a lot of storefronts, right? They don't need the infrastructure, so that'll save on their cost basis. They've renegotiated a lot of their kind of legacy leases, but ultimately all of this stuff will be online, and their average order is going up. So it's becoming more efficient for these retailers to sell online than it is, in store. And you don't have the personnel, you don't have the expenses of the brick and mortar. Camping World is the largest RV retailer in the world. It's hard to buy an RV online, but what they've done is you can now rent RVs, try before you buy from other owners. You have a service bay. They're rolling out to all 48 contiguous states, so you can purchase an RV in any state. So they're doing a great combination of organic growth. They're buying up a lot of mom and pop retailers, but it's a story where they're trading at less than 6 times earnings. They're paying a dividend over 5%. Marcus Lemonis is another owner operator, right? He owns 50% of the shares, and he's going to continue to aggressively buy back stock. So they just announced a $250 million share buyback, and they already started buying back aggressively at kind of the $39 range. So he's set a line in the sand. So what we like is to buy best in breed, kind of #1 or #2 players at very low valuations. And again, our average purchase price of Camping World is in the teens. So we like buying high quality stocks that are kind of industry leaders when their entire sector is in the penalty box. So high level, I'm not just a retail investor. We do lots of different sectors. I owned a lot of tobacco stocks 20 years ago in the heights of the master settlement agreement. I owned and purchased a lot of defense stocks when we were drawing down from Iraq and Afghanistan. If you can buy high quality companies that kind of own their industry at 6 or 7 or 8 times earnings, that's a 15 to 20% earnings yield. You can buy it, you can make a lot of money. And so that's the secret sauce here, is it's being willing to buy things that the average person would say, why do you want to own defense stocks, or why do you want to own tobacco stocks? But we really look at it in a portfolio construct as, how can we put up 20% plus annualized returns over a 3 to 5 year period of time with relatively low risk. And to me, I'm not willing to take the risks of leverage. I'm not willing to take the risks of, technology, where things can change so quickly that you don't really know what the company is going to look like 5 years into the future. So buying dominant players in kind of legacy categories in times of crisis, buying while there's blood on the streets is kind of a proven path to success.
Yeah, it's interesting because in the technology boom here, we get so caught up in, well, why buy consumer stocks, when, that could be so fickle and you can make 50% in a year buying these cloud stocks.
The question is risk reward. You could also lose 50%.
Right.
My favorite analogy from, when I was in school was, Amazon's always been a great company. They've always been a high growth company, but the stock price went down 90% between 1999 and 2003, even though they hit all of their guidance and doubled their revenue. So buying things at the right price is almost as important as buying growth. And it's also a weird kind of financial engineering. The lower the multiple, the lower the purchase price, the more financial levers you can pull. You can sell yourself to a strategic or financial for a big premium. You can do large, massively accretive buybacks. You can drive much stronger organic growth if you can fund it, from cash flow. So there are lots of different benefits that, unless you're really in the weeds, it's not common sense.
Yeah. So, and I guess what I was trying to say is, the consumer can be fickle. A recession could pop out of nowhere, and then where do these boring retail stocks go? But you have a methodology where you're picking these best of breed that not only are they top consumer brands, but they have that quality earnings profile and the margins so that they can survive a downturn.
Yeah, that's paramount. Is looking, for instance, last February and March, as we were in the midst of COVID, we really wanted to put together a portfolio of companies that would weather the storm, even if the Federal Reserve didn't act. And the all clear sign in March, there were 3 or 4 really extraordinary measures by the Federal Reserve to backstop the entire economy. So you could have bought low quality stuff, and ironically, that's what rallies the most in a recovery. But we are focused, number one, on capital preservation, buying things that are going to be around for the long run.
So I want to zoom out here a little bit. You just launched the ETF, EOPS, EOPS, and it was just launched in June. Now, so if somebody looks at that, they're not going to get, they're not going to see your track record. So can you talk to us about what your quantitative approach to value has achieved in terms of returns, for the last, 5 to 9 years?
Sure, I'll go back even further than that. I guess the account that these have all been managed in stemmed from my personal account at Fidelity. And so we have over a 12-year track record. On average, it's compounded in excess of 50% a year over the past 10 plus years. And Gabriel Hammond and I went to college together. We worked together at Goldman Sachs. We've known each other almost 25 years. And really, we put our heads together. I've been managing a pool of his capital for the past few years. And we decided to basically turn our personal portfolios into a publicly traded ETF for lots of different reasons. Number one is providing access so that retail investors can invest alongside us. But really, our goal is to compound our own money over a very long period of time aggressively and continue that kind of outperform the market in good environments and in bad environments. So we have the ability to hedge in a downturn. And that was part of the secret success last year is, February, March, April, we hedged our entire portfolio through index puts and through single stock puts, and we're able to basically escape COVID, unharmed, and then redeploy and rebalance and go from kind of market neutral or net short into a massively net long portfolio and ride the wave. And so our view here is there's full liquidity, there's full transparency. Investors can get in and out whenever they need to. They know what they own. They can invest alongside us, and we're eating our own cooking. So we have a significant portion of our own liquid net worth in these ETFs. But there's also a tax benefit to owning an ETF over a mutual fund or even stock in your own personal account because you don't have to pay taxes. It's essentially deferred until you sell shares of the ETF. So Gabe and I are doing this for the long term. We've really set this up to try to bring retail investors alongside us and participate in the same performance. But we do have an audit, and we will be posting it to our website. It will be in all of our marketing materials. It's now complete, and it includes Gabe's portfolio and my portfolio over, basically since inception.
Yeah. And another great thing I love about ETFs is if, when I talk to investors, if anybody's on the fence about a particular stock or industry or sector, I say, just buy this ETF. You've got, some degree of diversification in this basket. So you've got lower risk. And then it forces you, or at least sort of pulls you in to do more homework. Because then you look at the top holdings and you go, okay, why is this in there? And then you learn more about that company and then decide if you want to buy that company's shares outright. So you're actively managed, and you provide full disclosure of the holdings on the website, right? So if somebody goes to emles.com, is EMLES.com, they can see the whole family of ETFs that you guys have. You can see the top 10 holdings, and then you can download an Excel spreadsheet if you want to see the full holdings, correct?
That's correct. There's full transparency. We have 7 ETFs today. We're working on growing the number, but a lot of them are thematic in nature. So we have some luxury goods ETFs. We have some protective allocation ETFs, some real estate ETF, kind of across different themes. But this one specifically, Emles Alpha Opportunities, is really a traditional long-short fund in an ETF wrapper.
Okay, so one of the things that that got us together is I must have seen something in materials from your company about that you're looking at a potential inflection point in the market where we've got these, sky-high cloud stocks versus still very attractive value stocks. And so you say value investing works best when you can own stocks that are out of favor and that are trading well below their intrinsic value. And so what you're possibly seeing is that if there is some sort of market shift and the cloud comes down, that money will flow into some of these names that we've talked about.
For a number of reasons. I mean, first of all, it's never different this time. And I'm a big student of behavioral economics. I'm a big student of history and pattern recognition. And you're seeing the same mechanics that occurred 20 years ago. Whereas the hot sectors get asset flows and fund flows, and you really see sector rotation, basically, there are a lot of investors that are agnostic to valuation. They don't understand it, they don't care about it, and they will sell companies to, extremely low valuations in some sectors and overinflate other sectors. And I do believe that's going on, not just with the meme stocks, but with entire subsectors. And you can look at it through a P.E. Schiller lens. But essentially, in the late 1990s, you had a lot of brick and mortar companies, literally brick manufacturers and legacy home builders and companies that were trading at 4 and 5 times normalized earnings. Those sectors, while the NASDAQ was crashing 80%, those brick and mortar companies compounded at 30% a year for 5 years.
Wow.
And so my view, and I look at my stocks and my sectors very closely, is that just over the past 6 months, the average price to earnings ratio of my portfolio has traded from 15 times earnings to today it's less than 9 times earnings. And
really?
Generally it's like a rubber band that you pull back or you snap back. Stocks can always get cheaper, but the cheaper they get, the incrementally more upside there is. And you look at the broader market, right? The S&P earnings growth this year has been 20%. The market's up 20%. Basically, the index is trading at 22, 23 times earnings. The NASDAQ is trading at 33 times earnings and 28 times next year's earnings. The Russell 2000, which is really the barometer of small and mid-cap stocks, earnings have been up over 30% year to date. Next year's earnings have also gone up. And so the PE ratio on next year's earnings has fallen from 35 times earnings to 24 times earnings. So we're at about a third of the multiple of our comps within the Russell 2000. And that makes me feel very comfortable that almost irrespective of what happens to the macro or what happens to the economy, companies that are trading at 8 or 9 times earnings have dramatically more upside than downside. And so we use a rule that's called a 3-to-1 ratio. We only look for stocks where we think we can make 3 times as much money as we have the potential to lose. So we're looking for these asymmetric setups, which is the total opposite of what the meme stock mania and tech investors look for. They look for things that have some upside and some growth, but they completely ignore the downside risk.
Right. Yeah. So you said your EOPS fund names are trading less than 9 times this year's earnings versus 15 times 6 months ago. I mean, that screams earnings acceleration, right?
That's exactly what's happening is the earnings, the underlying earnings, the quality of the earnings are growing dramatically. The stocks just aren't getting the benefit of the doubt. So you're getting you have seen valuation compression over the last 2 or 3 quarters, but there's a limit. I mean, ultimately, these companies will get acquired by private equity. You'll have companies that are buying back their own stock, and the cheaper the stock is, the more accretive the buybacks are. So they have the tools at their disposal. And frankly, the best performing stocks of the past 20, 30, and 40 years have all been low valuation companies, whether they're defense stocks, tobacco stocks, automotive aftermarket companies like AutoZone, but companies, that have bought back 15% of their float annually, and you get this 20% total return to shareholders year after year after year, and they stay kind of perennially undervalued. And that's what we like. We'll avoid the herd. We'll own cheap things that, it's self-help. All you have to do is trade at less than 10 times earnings and use all of your cash flow to buy back stock, and you're going to grow your EPS, and ultimately you're going to grow your share price dramatically.
I notice when I look at the spreadsheet here of the full holdings, I see some home builders in here, which I like. I mean, they've obviously done well. And I think this housing boom will continue as millennials start to settle down and just create that whole dynamic of family formation and everything you buy along with that. We've also got some restaurants. I think you got the Dine Group, the Brinker Eat Group. Did the recent jobs or payroll data or GDP data affect your outlook on the consumer going back to restaurants or anything?
So I'd give myself a headache if I focus on every single economic data point. It's sometimes analysis paralysis. We think we're getting back to normalized restaurant demand. We're probably over-earning slightly in home builders in terms of profitability. They've had major pricing power that's kind of extraordinary as people have moved to the suburbs, and they can't fill the demand, right? Supply is constrained. So we think they're probably modestly over-earning, but the multiples are low enough that even on normalized earnings, they're still cheap. They're certainly cheaper than the market. We bought the builders and we bought the restaurants kind of middle and beginning of last year. So our next transition will be into a more defensive posture. I mean, pun intended. Defense stocks, companies with better balance sheets, companies that are less cyclical. When you're an industrials and cyclicals analyst, you want to own the trash at the bottom of the cycle. You want to own the highly distressed and levered companies coming out of a downturn and coming out of a recession. You want to own quality with moats and barriers to entry and less volatility and better balance sheets at the top of the cycle. So that's where our head is at. We're probably in the seventh inning, but you've got unprecedented fiscal and monetary stimulus, not just child tax credits and near zero rates. It's hard to imagine any of the home builders being as distressed as they were in the last financial crisis. So over the course of the cycle, and they've shown better kind of capital allocation, not just NVR, but a lot of the home builders are being run in a more prudent fashion. They're not out there overpaying for land. They're kind of allowing pricing to correct upwards.
All right, I want to talk about some of your shorts because you've got some in here. I see Peloton, Tesla, Roblox. What's your favorite short right now and why?
So I would say high level, we keep our shorts much smaller sized than our longs. This has been true historically. Our typical short sizes are 1% to 3% of our portfolio. We're always cognizant of infinite short squeezes. We're always cognizant of things that can go, quote, to the moon. And you've seen a lot of hedge funds blow themselves up by not having proper kind of risk parameters. Anyhow, we tend to short things. The corollary of being long value is to be short things that are dramatically overvalued. And so we tend to put together things that are either dramatically over-earning or companies that are going up against tough anniversaries, anniversarying challenging comps or blatant frauds or promoters. We tend to do companies that are over-earning and at the top of their economic cycle. So all of our shorts fit into that model. They're either dramatically overvalued, they're meme stocks, they're companies that are, had a great year last year, like a reopening trade would actually hurt somebody like Peloton or hurt somebody like Roblox. And then there are things like Tesla, where if you're still not profitable at this point in the economic cycle, when a recession hits, you're toast. So high margin companies have that more defensive attribute during a recession. Low margin companies get taken to the woodshed. They're forced to go out and issue stock or raise capital basically at the worst possible time. And so our view is we will short a basket of companies that are either low margin, Wayfair kind of fits that model relative to Restoration Hardware, or that are more cyclical.
Gotcha. You mentioned, roughly speaking, that we could be in the seventh inning of this cycle. And every investor has to have their own perspective on that. I saw Jerry Castellini of Castle Ark on CNBC a couple weeks ago, and what I really liked was his view that, he said we could be looking at another 3 to 4 years in this expansion, and what I especially liked was his view of the strong consumer with solid balance sheets, lots of liquidity, and pent up spending demand. And what was really noteworthy about his consumption wave thesis was that even with wage and inflation pressures, that corporations like you talk about with solid margins that have pricing power and they don't need to discount, that they'll be doing well. Like this isn't peak margins for a lot of these companies. Would you agree with that?
So that's absolutely the case. If you think about it, higher wages, I guess you could claim it's a negative for most business profits, but it's certainly a positive for consumption. And it's the same thing with inflation. In a slightly mildly inflationary environment, it actually allows retailers to raise pricing. And you're seeing it across the board. I mean, I think retail profit margins are closing in on all-time highs. Consumption, right, as measured by the macro data, is actually like 15 or 20% above the level of 2 years ago. So we're at all-time record highs, but I don't think that ends anytime soon. You look at these child tax credits, $300 and $350 per child per month. There is a big stimulus coming, and we will build up bubbles, but ultimately for the foreseeable future, for the next 12, 18, 24 months, I think the benefit of pricing power is that it all drops to the bottom line. And as an investor, I would much prefer, healthy operating margins, even without the top line growth. And so I think we're seeing a higher quality of earnings, and it gives me a little bit of a safety factor that with higher margins, they can weather a downturn. So that's my view.
All right, so talk to us about Lockheed Martin or any other defense stocks you want to, since that's been your wheelhouse for a long time. When is the time to go all in on Lockheed Martin? So
it's first of all important to know that Lockheed Martin and SAIC, there's basically a monopsony. There's one customer. It's the U.S. government, and I call them glorified utilities. They kind of have mid-teens margins. And it's steady state, right? You can kind of set it and forget it. They grow top line at 3% a year, almost irrespective of the fiscal environment. So it doesn't matter if you go into recession. These budgets are pretty steady Eddie. And I've looked at history over the past 40 years. There's never really been a time where in nominal dollars, defense budgets have gone down. It's sort of analogous to, health insurance costs. They never really seem to go down. And so it's just a great defensive industry. They're well-run companies. They're capital light industries. And in my mind, they always traditionally traded a 25% discount to the market. They outperform the broader market 80% of the time. And today you're able to get SAIC and Lockheed Martin at about 12 times next year's earnings. And generally, when they get to this much of a discount of the market, they start to be aggressive buyers of their own stock. And so that's when you see just massive outperformance. The last time you saw it was 2012, 13, 14, where, for instance, Lockheed Martin bought back almost a third of their float, and the stock quadrupled over a 3-year period of time. So it's always hard to get it down to the exact week or month or even quarter. But I just think from a risk reward perspective, if the economy goes into a recession, defense stocks don't just outperform, they go up on an absolute basis. And so this thought of putting together a portfolio with shock absorbers that are embedded in it, we went back and looked at every single time through history that the S&P 500 has dropped 5% in a month, or any month that the VIX has spiked. And essentially 90% of the time, defense stocks go up on an absolute basis. So you get the outperformance relative to the market, and you get alpha, you get actual dollars of return.
Right. I like that, the shock absorber in your portfolio. Well, Nathan, it was great having you on Mind Over Money, and you've given us some very fresh eyes on not just value stocks, but how to play the cycle and how to play defense, especially when we're staring at these sky-high valuations in cloud and technology. So thanks for joining us, and wish you the best with the Emles family of ETFs, especially your new one. And we'll look to have you back on soon.
I appreciate it. Thank you, Kevin.
All right. And for listeners out there, there will be, and no matter where you're listening, Spotify, Apple, iTunes, There will be an article version of the podcast, not a full transcript, but some rough notes, different ideas on Zacks.com. You'll find the article version. So just click the link in the show notes there. And thanks for joining me in Mind Over Money. We'll talk to you soon.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.